US credit downgrade, the beginning of the end? What Fitch knows that you don't. In August 2023, something happened that barely made headlines, but could shape the future of global finance. Fitch Ratings, one of the world's top 3 credit rating agencies, downgraded the United States long-term credit rating from AAA to AA+. It was only the second time in history that America lost its prized AAA status, a label that has long symbolized unshakable economic power and political stability. For most people, it sounded technical, bureaucratic, easy to ignore. But for those paying attention, it was a seismic signal. The foundation of the global financial system just cracked a little. Why does this matter? Because US Treasury bonds aren't just American IOUs. They are the lifeblood of the global financial order. They are what central banks hoard, what investors trust in times of crisis, and what backs the US dollar, the world's reserve currency. When Fitch pulled the downgrade trigger, it wasn't simply making a statement about American debt. It was calling into question the credibility of the world's most trusted borrower. In this episode, we ask the question few dare to confront: is this the beginning of the end for US financial supremacy? We'll unpack why the downgrade happened now, what it says about Washington's political dysfunction, how global markets and foreign powers are reacting, and what it could mean for the future of the dollar itself. This isn't just about one rating. It's about a deeper erosion of trust, and once trust fades, everything built on top of it starts to shake. Let's find out if the world's most powerful debtor nation is on the brink of a reckoning. Welcome to Money Minded. Chapter 1. What the downgrade really means. Credit ratings are the lifeblood of trust in global finance. When a country borrows money, just like a person applying for a loan, lenders want to know how reliable that country is. That's where credit rating agencies like Fitch, S&P, and Moody's come in. Their assessments, often reduced to a few simple letters, AAA, AA+, carry immense weight in how markets perceive risk. For decades, the United States enjoyed the coveted AAA rating, the gold standard of financial trust. A symbol that America always pays its bills, even in times of crisis. But in August 2023, Fitch sent shockwaves by lowering that rating to AA+, citing a steady deterioration in governance, rising fiscal deficits, and growing debt burdens. To the casual observer, dropping from AAA to AA+ might not seem like a big deal. After all, it's just one notch down. But in the world of sovereign debt, perception is everything, and Fitch's message was loud and clear. The US government's financial health is no longer pristine. So what triggered this shift? According to Fitch, it wasn't just about numbers, though the numbers are alarming. The US national debt surpassed $34 trillion in 2024, and its interest payments are projected to exceed military spending. But what really rattled confidence was Washington's political dysfunction, the near defaults over debt ceiling debates, repeated government shutdown threats, and a growing inability to govern with fiscal discipline. In Fitch's own words, there has been a steady deterioration in standards of governance over the last 20 years. Translation? The world's most powerful democracy is showing signs of financial mismanagement, and it's no longer being ignored. Now, let's talk about what a downgrade actually does. First, it raises borrowing costs. US Treasury bonds, often seen as the safest investment in the world, are priced based on perceived risk. When that risk rises, even marginally, yields go up. That means higher interest payments for the government, which feeds back into the deficit. A vicious cycle begins. Second, it sends a message to global investors and institutions. Many pension funds, insurance companies, and even central banks have strict rules about how much exposure they can have to assets below AAA. Some may be forced to reduce their holdings of U.S. debt, or at least diversify more aggressively. Third, and perhaps most importantly, it signals a shift in confidence. Markets run on belief. If the belief in U.S. financial superiority weakens, alternatives will start to gain traction, whether that's gold, digital assets, or even other sovereign bonds like those from the EU or China. It's worth noting that Fitch wasn't the first to act. Back in 2011, Standard & Poor's also downgraded the U.S. credit rating following a similar debt ceiling standoff. At the time, markets were briefly shaken, but the dollar remained dominant. So what's different now? In 2011, U.S. debt stood at $14 trillion. Today, it's over double that. The political divides are deeper, the global order more fractured. And new financial challenges, like BRICS nations and central bank digital currencies, are rising in the background. This time, the downgrade comes in the context of systemic instability. Let's not be mistaken, the United States is still the largest economy on Earth, and U.S. Treasury bonds are still widely regarded as safe. But safe is no longer synonymous with untouchable. The downgrade is a warning that cracks are forming, and those cracks are widening. In the end, this isn't about panic. It's about perception. And when it comes to sovereign credit, perception is power. In the next chapter, we'll explore why Washington's inability to rein in its spending, and its increasingly chaotic fiscal politics, is fueling the loss of that perception. Because the real downgrade might not be on paper, but in the minds of those who once believed the U.S. could never fail. Chapter 2, A Broken System, Why Washington Can't Fix It. When Fitch downgraded the U.S. credit rating, the numbers were only half the story. The real concern was dysfunction, not just in economics, but in governance. In this chapter, we pull back the curtain on a political system so entangled in partisanship, short-term thinking, and institutional gridlock that managing debt responsibly has become nearly impossible. Let's start with the debt ceiling. The U.S. is one of the only major countries in the world that imposes a legal cap on how much its government can borrow, a limit that needs to be raised or suspended periodically. In theory, it's a check on reckless spending. In practice, it's a political weapon. In recent years, this process has turned into high-stakes brinkmanship. Congress has repeatedly brought the U.S. to the edge of default, using the debt ceiling as leverage in partisan battles. These games might excite political bases, but to investors and foreign governments, they scream one thing: instability. Fitch made it clear, these repeated debt ceiling standoffs were a major factor in their decision. Why? Because they show the world that the U.S. can't guarantee timely payment on its obligations without a last-minute rescue, driven by politics rather than principle. But the debt ceiling is just the tip of the iceberg. Look deeper, and you'll see a federal budget increasingly on autopilot. Over 70% of spending is mandatory: Social Security, Medicare, Medicaid, interest on the debt, leaving very little room to cut or adapt. Meanwhile, tax revenues haven't kept pace with expenditures, especially after repeated tax cuts under both Republican and Democratic administrations. What's worse, no one seems willing to touch the real issues. Entitlement reform is politically untouchable. Raising taxes is a career ender in most districts. Cutting military spending? Also politically radioactive. As a result, the only path forward has been more borrowing, masked by the illusion that low interest rates would make it sustainable forever. But interest rates aren't low anymore. The Federal Reserve has raised rates aggressively to combat inflation, and suddenly, the cost of servicing the national debt has exploded. In 2025, the U.S. will spend more on interest than on national defense. And unlike military spending, interest payments buy nothing. They are simply the price of past excesses. So why can't Washington act? The short answer: incentives. Politicians are rewarded for short-term wins, not long-term responsibility. Election cycles are 2 or 4 years. But debt consequences play out over decades. Kicking the can down the road has become the safest political strategy until, one day, the road ends. Meanwhile, the public is more polarized than ever. One side demands more spending. The other demands lower taxes. Neither accepts compromise. And in the middle, global markets are watching a once disciplined government lose the ability, or the will, to manage its own books. Even proposals for bipartisan fiscal commissions or automatic stabilizers are met with fierce resistance. Washington has become a place where solving big problems is politically dangerous. And avoiding them is politically safe. This is exactly what Fitch meant by a deterioration in governance. It's not just about gridlock. It's about a system structurally incapable of self-correction, a democracy too divided to save its own credit score. And that's the real danger. Because a downgrade on paper may hurt. But a government that's lost the trust of its creditors, not because it can't pay, but because it can't govern, faces a far more existential threat. This is how reserve currencies begin to fade. Not with collapse, but with complacency. In the next chapter, we'll look beyond Washington to the rest of the world. Because as America falters, other nations are starting to take notice and take action. Chapter 3: Global Repercussions: Why the World is Watching Closely. The United States may still believe its credit rating is an internal affair. But in today's interconnected world, nothing about America's debt is purely domestic. For decades, U.S. Treasury bonds have functioned as the anchor of global finance. They're considered risk-free assets, used by governments, banks, pension funds, and investors across every continent. The U.S. dollar, backed by trust in those bonds, is the foundation of global trade, energy markets, and foreign reserves. So when the U.S. gets downgraded, it doesn't just shake Wall Street, it reverberates across Beijing, Brussels, Riyadh, and beyond. Let's look at the immediate impact first. In the wake of the downgrade, bond yields rose slightly as investors priced in marginally higher risk. But the bigger story was the signal it sent. Countries holding trillions in U.S. debt, like China and Japan, were reminded of just how much exposure they have to an increasingly unstable fiscal entity. China, for instance, holds over $800 billion in U.S. treasuries. In the past, this was seen as a safe bet, a way to park excess trade surplus in the most liquid, trusted asset on Earth. But with Washington lurching from crisis to crisis, Beijing has been gradually reducing its holdings and diversifying into gold, euros, and even commodities. This isn't just financial hedging, it's geopolitical signaling. Across the BRICS bloc, Brazil, Russia, India, China, and South Africa, leaders are questioning whether they should continue relying on the US-centric financial system. In 2024, BRICS even announced efforts to create a shared currency for trade settlement, specifically designed to reduce dependence on the dollar. Russia, sanctioned and frozen out of dollar markets, has been especially vocal. Moscow has dumped most of its US assets, pivoting to yuan and gold. While its motives are political, the broader message resonates: US dominance comes with strings and risk. Even America's allies are reconsidering their exposure. The European Central Bank, the Bank of Japan, and Gulf sovereign wealth funds are quietly increasing diversification. Not abandoning the dollar, but hedging against the possibility that the world's most trusted borrower is slowly becoming just another debtor. And here's the kicker: once enough people hedge, the system changes. The dollar's supremacy depends on everyone else believing it's supreme. That belief keeps US borrowing costs low, allows endless deficit spending, and sustains the American standard of living. But if enough nations begin shifting toward other reserve assets, even slightly, the demand for dollars begins to fall. And when demand falls, costs rise. A weaker dollar could mean higher import prices in the US, rising inflation, more pressure on the Federal Reserve to raise rates, and a vicious cycle where America has to borrow more just to stand still. And what about global markets? Rating downgrades from top economies send ripples through the financial system. Risk models used by institutions around the world are tied to the assumption that US debt is risk-free. When that assumption is challenged, portfolios are rebalanced, premiums are reassessed, and volatility increases. In 2011, after the S&P downgrade, markets briefly plunged. But they recovered quickly, partly because the Eurozone was also in crisis. There was no alternative. But now, in 2025, the global landscape is different. Alternatives are rising, not just in currencies, but in payment systems, trade agreements, and geopolitical alliances. That's what makes this downgrade more dangerous than the last. It comes at a time when the world is already searching for Plan B. The downgrade may not spark immediate panic, but it accelerates a long-term shift that's already underway: the slow, deliberate diversification away from US-led financial dominance. Trust, once broken, doesn't always collapse. Sometimes it quietly moves on. In the next chapter, we'll confront the uncomfortable question: is the US dollar still the bedrock of global finance? Or are we witnessing the early signs of a multipolar monetary world, where America is just one of many players? Chapter 4, is this the beginning of the end for dollar hegemony? For over 8 decades, the US dollar has been more than just a currency. It's been a symbol of global power, a tool of influence, and a pillar of stability in an unpredictable world. From oil trades to international loans, from emerging market reserves to sanctions enforcement, the dollar has been the invisible architecture behind modern geopolitics. But now, cracks are appearing in that architecture. The question isn't just whether the dollar is still dominant, it's whether that dominance is sustainable in a world that's rapidly changing. Let's go back to the beginning. The dollar's rise to global supremacy was forged in 1944 at Bretton Woods, where nations agreed to peg their currencies to the dollar, and the dollar to gold. Even after the US abandoned the gold standard in 1971, the dollar retained its central role thanks to deep capital markets, rule of law, military might, and, crucially, trust. That trust wasn't just in the dollar itself, but in the system that backed it: stable governance, fiscal discipline, and a reliable commitment to debt repayment. The very things now being called into question. The 2023 downgrade by Fitch didn't trigger an immediate collapse. But it was a symbolic moment, a formal acknowledgement that the pillars of trust are eroding. And in a world looking for alternatives, symbolism matters. So, is dollar hegemony truly at risk? Let's look at the trends. First, de-dollarization is no longer just rhetoric. Countries like China, Russia, Brazil, and even France have settled major energy deals in yuan or euros. Central banks are adding gold and other currencies to their reserves. BRICS plus nations are exploring the creation of a new currency basket aimed at bypassing the dollar entirely in cross-border trade. Second, the weaponization of the dollar is backfiring. Sanctions, particularly after Russia's invasion of Ukraine, have shown the world how easily access to dollars can be restricted. Many nations now fear that being too dependent on the US financial system makes them vulnerable to political coercion. Third, the rise of digital alternatives. Central bank digital currencies, CBDCs, especially China's digital yuan, offer a glimpse into a future where transactions can bypass SWIFT and the dollar completely. While not yet dominant, the infrastructure is being built, and fast. But let's be clear, the dollar's fall won't be dramatic. It won't vanish overnight. Why? Because no other currency currently offers the same liquidity, convertibility, depth, and legal protection that US assets still provide. The euro is constrained by political fragmentation. The yuan is tightly controlled. Gold lacks yield. Crypto is too volatile. What we're witnessing is not a collapse, but a gradual rebalancing. Think of it like the Roman Empire. It didn't fall in a day. It slowly lost influence as rivals rose. Borders weakened, and institutions eroded. Similarly, dollar hegemony may erode not from one big event, but from a slow bleed of confidence, compounded by structural dysfunction at home and diversification abroad. So is the US doing anything to stop this? Unfortunately, the signs are bleak. Rather than addressing deficits, reforming entitlements, or stabilizing politics, Washington continues to delay hard choices. Monetary and fiscal coordination is fraying. And the growing perception globally is that the US no longer prioritizes its financial credibility because it thinks the world has no better option. That complacency may prove to be the greatest risk of all. Because if enough nations, enough investors, and enough institutions begin to believe that the dollar is no longer unrivaled, then the self-fulfilling prophecy of decline begins. The downgrade by Fitch may be just one small step in that narrative, but it marks a psychological turning point. In the final chapter, we'll bring it all together, what this means for investors, nations, and ordinary people around the world. Is the US headed for a reckoning, or will it adapt in time? Let's find out. Conclusion: the path forward, adapt or decline. A credit downgrade may seem like just a technical event, a few letters on a spreadsheet, a headline in the news cycle. But in reality, it is much more than that. It's a mirror. One that reflects the uncomfortable truth about where the US stands today in the global financial order, and where it may be heading. For generations, the United States earned the world's trust, not just through power, but through responsibility. Through its commitment to stability, transparency, and leadership in times of crisis. The dollar became the global currency not because it was forced on the world, but because the world believed in it. But belief is fragile. And trust, once broken, rarely returns in full. The downgrade by Fitch is not the end. It is a warning. A signal that the world is watching, and quietly repositioning. America's fiscal house is under stress. Its politics are deeply divided. Its ability to self-correct is in question. And in that vacuum, new players are rising, new systems are forming, and new ideas are taking hold. The question now is not whether the US has the tools to fix its trajectory. It does. The real question is whether it still has the will. Can Washington overcome its dysfunction and chart a path back to fiscal responsibility? Can it invest in long-term stability over short-term popularity? Can it recognize that global power, in the 21st century is not just about military strength or economic size, but about credibility. Because credibility is currency. And when credibility weakens, so does everything built on it, including the dollar. For investors, this moment is a wake-up call. Diversification isn't optional anymore. Geopolitical risk is no longer background noise, it's a central factor in every financial decision. Gold, emerging market exposure, digital assets. And even hard commodities are no longer fringe, they're protection. For policymakers, the time for political theater is over. Real reform, tax code modernization, entitlement restructuring. Strategic spending must return to the conversation. Or the consequences will no longer be theoretical. And for the world? We may be entering a new monetary age, one where no single power dominates, and where resilience means being ready for a system that is more fragmented, more digital, and more competitive. The U.S. can still lead in that world, but only if it earns that role, again. Because history doesn't reward those who were powerful. It rewards those who adapt. So is this downgrade the beginning of the end? Not necessarily. But if the warning signs are ignored, it might be. Stay informed. Stay diversified. And if you found this video insightful, don't forget to like, subscribe, and share Money Minded, where we break down the world's most important financial shifts, one story at a time.